I am Dale Bonner. I'm a senior advisor here at the Milken Institute and also privileged to serve as the executive chairman of Plenary Concessions, which is an international investor, developer, and operator of public infrastructure. We have a portfolio of just under $20 billion worth of public assets under management in Australia, Canada, and now the U.S. as well. We are here today to talk about the infrastructure picture broadly. The Milken Institute over the last couple of years has done a number of sessions and convened a number of conversations around the question of infrastructure as an asset class and whether it's really picking up steam and presents a suitable market for investment as of today. And so we're going to talk a little bit about that. I wanted to first put up slide number 1, if you would. Everybody in the room, if you've even followed even in the most casual way the infrastructure conversation, you've seen some version of this slide before that shows what the American Society of Civil Engineers, the grade that they have given America on the quality of our infrastructure and infrastructure investment. If you look at slide number 3, I believe it is, as a result of many years of underinvestment, we are ranking just, I think, number 16 or so behind many of our global competitors in the quality of our infrastructure. And then if you put up slide 9, I believe it is, you'll see that where we are, that these are still reasonably accurate, and you'll see that the U.S. is far behind China and India in our level of investment as a nation in all forms of infrastructure. And so we're going to talk a little bit about today. So many of you know that years ago in Europe, in the UK and Spain and elsewhere, one of the strategies that they had initiated some years ago were private investment initiatives to attract private capital and in various forms of public-private partnerships and concessions and other formats. And today, Europe is not building very much either. They have their greenfield markets are somewhat slow, and they have very tight and competitive brownfield or market for brownfield and secondary investments, but not building very much new. So today we're going to talk a little bit about, we've got with us 3 experts who can speak to some of the core issues that we're involved with. To my left, we have Jim Pass, who is a senior managing director with Guggenheim, who has a number of exciting things going on in the market that you'll tell us a little bit about, but they have been building out their infrastructure and real estate platform for some time over the last several years, and so we'll hear a little bit about the perspective from institutional investors. And then we have to my immediate right, Chuck Harrington, who is the chairman, CEO, and president of Parsons Group, which is a global infrastructure business. So he's designing, building a lot of interesting projects across many sectors around the world. And so we're going to hear a little bit about how the world looks like, or how the world looks from the perspective of a CEO who's got a lot of things going. And then to my far right is Congressman Delaney from the state of Maryland, who has been working very hard on some national legislation that is intended to change the way in which we fund and finance infrastructure, and so he'll have some news, hopefully some good news, to tell us about the traction that he's been getting in Washington with that legislation. But at the end of the day, there needs to be a lot of people in this conversation to really make major progress on something as broad and amorphous as infrastructure. Not only are there multiple sectors that we could think about, from transportation, water, energy, and so on, but there's also various forms of investors who approach the market in various ways with different strategies. And all of us over the years, and then it's not even to speak of the number of professional services firms, lawyers, accountants, advisors, others who are out there who are very much vested in the space as well. But a number of people have been working on this for a number of years to try to really reform the way in which we in the U.S. in particular invest in infrastructure and make sure that we have ways to tap the very large sums of private capital that have been raised over the years and are available for investment. So we're going to get into as many of those issues as we can today. We'll go a couple rounds of questions with our panelists, and then we'll make sure that we save some time, hopefully invite some of you into the conversation as well. So with that Jim, why don't I start with you? Why don't you
Sure.
tell us a little bit about Guggenheim and in particular what your infrastructure strategy is?
Well, I think it's, thank you, Dale, and thanks for coming to the session today. I think at Guggenheim it's important to realize that infrastructure is it's really a great tool to diversify our portfolios. It allows our clients an equity opportunity as well as a fixed income opportunity. And as Dale said, there's different parts of infrastructure that you can be a developer in the beginning. You could help build the asset, or more importantly, you could really be the participant that provides the permanent financing. And so we look at it as really an opportunity for project life cycle, and that attracts different capital to different projects. And I think we've been able to use that strategy to really attract institutional money for whether it's a power plant or social infrastructure or so forth. As the market continues to evolve, and I think that's one aspect that in the United States we're somewhat behind the rest of the world, because in this country we have a tax-exempt market which is very, very efficient, but now we're beginning to see different tools, and whether they're initiatives from the Congressman or other leaders in Washington on how do you supplement that program. So at Guggenheim, our objective is to find some income-generating projects that have a contracted revenue stream. So we have a dedicated revenue stream very similar to how we analyze fixed income bonds. As well as we want to make sure that one thing that's important to realize that infrastructure is less correlated to other asset classes. So when you are managing institutional money or looking at a fund, it is a great opportunity for diversification and really to react to different market trends. And the last thing I would say is about infrastructure, it also is it's an asset class that gives you opportunities because it is something that's still evolving. So not a lot of institutions have dedicated a team, like we have at Guggenheim, to find those spaces. And it's very similar that it's a new asset class, and so typically when it's new, there's greater spread, there are greater opportunities, but when it fully gets vetted, that's really when sometimes that opportunity becomes marginalized to a certain degree.
Thank you. Chuck, when you tell us a little bit about Parsons and what you see kind of going on in the world in terms of interesting sectors and investment opportunities, but one thing that Jim mentioned also is about building out teams to take on different parts of this. And I noted, you can comment now or later in the conversation, but I know Parsons also has a new kind of dedicated unit that's intended to help you get engaged with the market a little differently than you had historically. So tell us a little bit about Parsons generally, but if you want to tell us also about the new arm of the business, that'd be helpful as well.
I'll do that, Dale. Thank you. And thank you for inviting me to speak on the panel. Parsons is 70 years we've been involved in delivering, sustaining, and protecting infrastructure, industrial, environmental, defense, and security solutions on a global basis. So on any given time, we're working as a designer, a constructor, a financer, operator, maintainer of large infrastructure assets. And what we see around the world are really two types of developments going on. Those in developed worlds and countries where you have something that's there, but now it's undersized, it's out of date. And in undeveloped worlds where you're building something for the first time. And when you're working in a developed society, redeveloping infrastructure it's more costly, it's more timely, it's more disruptive than doing it clean for the first time. So that's where we face in this country. Is we have very developed infrastructure, but now it's undersized, it's end of useful life. So as we saw the infrastructure market changing in the United States about 10 to 12 years ago, we saw the future being first design build and then design build finance, or P3s. And we created Parsons Enterprises to respond to that. And as we look going forward, whether it's the Middle East, Canada, Singapore, around the globe, we see more and more investment opportunities, and communities getting more sophisticated on how they're really financing these and looking for the synergy between private finance and public need. They're not always 100% in a line, but as you work more together, you can find areas of synergy. You can actually deliver an asset that meets public need but allows investment opportunity for private finance.
Excellent. And of course, you're building projects that have not only private finance but also public.
Yes.
The workhorse of your business, I believe, is government-funded assets. Is that
Yeah.
correct?
So if you look at our asset base, we do on the transportation infrastructure side, we do airports. So right now we're doing Mexico and Abu Dhabi and Dubai as an example, and Doha. very large airports, bridges, tunnels, roads, highways, rail and transit systems, also water and wastewater systems, and we're seeing more investment opportunities there. On the government side, we're far more defense, intelligence, security oriented. And in industrial, that's where we see power plants, oil and gas lines, storage systems, and the like, where we see investment opportunity.
Excellent. One of the things that often gets lost, I think this crowd would appreciate, but in the broader public conversation, there's often, I think, some miss the distinction between private finance, which is what you're or helping to contribute to, and public funding on the other. So whether it's Guggenheim or even an investor and developer like Plenary Group, we invest equity in projects, but of course you have to have some source of revenue to pay back the investment and make some reasonable return, and that of course means the government's got to have some revenues available to make these investments. Congressman Delaney, if you would, before you tell us about the Infrastructure 2.0 Act, also just maybe you comment also on how it was that you got to champion that legislation. I mean,
Sure.
your perspective on infrastructure generally and how you've been working on it from the public funding standpoint.
Great. Okay. Well, thank you, Dale, and thanks for having me on the panel with such great experts here. And I was really glad that you opened up with the slides you did, because it really makes the case very well, in my opinion, as to why increasing our investment in infrastructure in a smart, fiscally responsible way should be the top domestic economic priority of the United States of America. And the data you shared with us, I think, makes a very good case for why we need to do this to improve the lives of our citizens, first and foremost. And bad infrastructure really hurts communities, because when people are stuck in traffic, spending 4 hours a day commuting back and forth from work to their home, they're not reading to their kids, they're not spending time in their communities, and it's really eroding the quality of many of our communities. So first and foremost, we need to do this for our citizens. Also, it's a huge issue for our competitiveness as a nation. We're not going to be able to compete in this technology and global interconnected world nearly as successfully as we could unless we really bring up or close this gap, this D+, to bring it up to like an A- would be $3 trillion or something like that. So, but the flip side is it's a big opportunity, because infrastructure happens to be the second best investment the government makes. If you look at all the data coming out of the federal government about multiplier effects, for every dollar we spend of government money, how much economic growth do we get? Infrastructure is number 2. We get about $1.92 of economic growth for every dollar we spend on infrastructure. What's number 1 is basic research, which is $2.40 for what it's worth. But $1.92 is infrastructure's multiplier. We spend a lot more money on infrastructure. So it's a really important thing to do. And it creates the kind of jobs that we need in this country right now, because while we're creating jobs in this country, we're creating high-skilled and low-skilled jobs. We're not creating middle-skilled jobs. And infrastructure disproportionately creates those middle-skilled jobs, not only in terms of the people who build the projects, but also in terms of manufacturers and all the other kind of downstream contractors. So I think you can make a case, a really compelling case, for the U.S. domestic economic policy solely around infrastructure. So what I wanted to do when I came to Congress, I wanted to increase our investment in infrastructure, but I wanted to do it in a way that was fiscally responsible. So I looked where the money was, and it turned out all the money is overseas in terms of additional investment opportunity. About half of U.S. corporate cash sits overseas. It's almost $2.5 trillion right now, out of $5 trillion of total U.S. corporate cash, which is a staggering amount of money, and it's sitting there because we have a flawed international tax system that effectively double taxes our international corporations on their earnings overseas, but allows them not to pay that double tax if they defer bringing their money back to the United States. So we've created this weird system with our largest corporations that effectively encourages them to keep their money overseas, and the United States is theoretically owed a lot of tax on that money, but none of it's getting paid. So, and none of the money's coming home and being invested in the country. So we came up with this idea of creating a new infrastructure fund that would be used by states and local governments to fund infrastructure projects. So it wouldn't be used by the feds, it would just be used by states and local governments. And we created a way of capitalizing the fund that involved private companies putting the money in. So we envisioned this fund, which we called the American Infrastructure Fund, to be capitalized with $50 billion of capital. And that capital would go in, it would effectively be the equity, and it would stay there for 50 years. And the fund could be leveraged, and it would be structured as a nonprofit, and it would make capital available to these states and local governments. And the $50 billion would be put in by U.S. corporations. And the way they put the money in is they'd buy bonds that have a term of 50 years, pay 1% fixed interest rate, and are not guaranteed by the government. So none of them would ever buy these bonds, except we say that for every dollar of these bonds a U.S. company buys, they get the right to repatriate a certain amount of their overseas earnings back to the United States tax-free. And that mechanism was kind of an auction mechanism. So if Apple would bid to buy $1 billion of bonds, they might bid 5 to 1, so they buy $1 billion of these bonds, and then they could bring back $5 billion from overseas tax-free. So we were effectively tying in some of that money overseas, creating a path for it to come back that's tax-free to the companies, provided they put some of the money in this new infrastructure fund. And this idea got a lot of legs. We ended up with 100 members of Congress on the bill, 50 Democrats, 50 Republicans. It was introduced in the Senate. We had about 100 groups supporting the bill, think tanks on each side of the aisle, labor, chamber. It became really a big bipartisan effort. And it showed that there's a deal to do around international tax reform and infrastructure, which seems like a strange deal when you hear about it the first time, but it intuitively kind of makes sense. And the reason it makes sense is because we have a real missed revenue opportunity with respect to this money sitting overseas. They theoretically owe a lot of tax, but none of them are paying it. So, we started thinking about how do we even do something bigger this Congress. So we reintroduced the bill that I just described. But we also reintroduced another bill that basically not only creates the infrastructure fund that I talked about, but also deals with something called the Highway Trust Fund. And the Highway Trust Fund is how we fund 90% of the surface transportation projects in this country. And it's funded with the gas tax. The problem is we haven't raised the gas tax in 20 years. So the amount of money that flows out of the Highway Trust Fund is twice as much as the gas tax revenues. So the government's got to make up the difference. And that's a big fight all the time, right? How we do that. We do it with all kinds of weird short-term fixes. But the other problem with it is we don't ever raise the amount we're really funding, because it's so hard to find the money to plug the gap that the last thing you're going to do is start raising how much you fund, which is why you get some of these crazy numbers that we're looking at where we're way under investing in our infrastructure. And since there's no appetite to raise the gas tax in the Congress right now, whether there should or shouldn't be is a whole other discussion, suffice to say there's none, we said let's do a bigger fix on the international tax system, and let's take some of the money and put it towards the Highway Trust Fund. So what our new bill, and I apologize for this incredibly long-winded introduction, but what our new bill does is says that you take the $2.5 trillion that sits overseas, and you take away the company's ability to defer their tax on that money. Right, so you end the deferral option, which they're really upset about for an instant. But then you also say, we're going to cut your tax rate from 35 to 8.75%. So then they're happy again. And what that means is they have to pay tax on the money. In aggregate, they'll pay $170 billion of tax, but then they can bring the money back and forth. So you do what's really weird, unusual in government, which is you deliver a very significant tax break, but you actually raise revenues in the process. And that happens because you're getting rid of this weird deferral option, which is kind of a wrinkle around behavior. And we take the $170 billion, and then we allocated $120 billion of that to the Highway Trust Fund, which creates basically 6 years of funding. So we do a full 6-year transportation bill, which people will be really happy about. But we also funded at much higher levels. So if we just funded it at the current levels, it would be $90 billion. Instead, we're now funding at $120 billion. And then we take the other $50 billion and we set up the infrastructure fund that was in our first bill. And then we do some other things to fix the tax system going forward, which I won't burden you with any more description of my bill. But that's what we're doing.
Let me ask you on the American Infrastructure Fund portion of it. In Canada, for example, and they have a much longer history than we do here in the U.S. of partnering with the private sector, attracting private capital. And the federal government there has a national fund, but one of the purposes of the fund is to incentivize municipalities to attract private capital to their infrastructure projects. Would your fund have any similar mechanism,
it
or
does
speak to how the money is actually invested?
So what our fund does, we believe our fund could be ultimately $500 billion to $750 billion in size. Because if you took $50 billion and of equity and you said that most of the financing is municipal credit, you could assume that you'll get 10 to 15 to 1 leverage on this thing. So you're getting $500 billion to $750 billion of a 50-year revolving fund, by the way. So that's a couple $1 trillion over 50 years. But what we say, it can only be used by states and local governments, so it's not a national fund, which a lot of people don't like. But a lot of people are also very worried that if you make it a national fund, it only goes to the 5 big cities. So to make it as bipartisan as possible, to get my Republican colleagues more interested in it, we decided to make it a state and local government-oriented fund. But we also said that if you don't have robust public-private partnership legislation in place that allows the kind of deals we all think we should be doing, you'll only get 65% of your allocation. So every state gets an allocation effectively based on their economic size, except if you don't have public-private partnership legislation in place, then you only get 65% of your allocation. To create an incentive for legislatures who really want to get public-private partnership deals done to be able to pound the table and say, look at all this money we're leaving on the table by not having these frameworks. So we do, in fact, create that incentive.
In fact, there's a slide also here that shows the map of the U.S., the states that have legislation in place to authorize P3s, private investment. Jim, let me ask you, as we're looking for that slide.
Sure.
I mean, at the end of the day, these are still illiquid assets, right?
Yep.
And so we're not talking about, this isn't the same conversation that some were having several years ago when there were a number of funds that were really looking for private equity-like returns in order to, acquire assets and generate higher returns. When you hear, the opportunity presented by the proposed legislation and think about your platform, does it change your view in which or does it change your thinking about the level of interest that institutional investors would have in that one fund versus what you're offering?
Well, I think it really crystallizes the challenge. I mean, you can hear how complicated an infrastructure bill or an act has to get, how many shareholders or stakeholders have to get approve it in Washington. And just imagine my team, we're sitting back and we're analyzing a power plant project or a toll road project, and we know that future projects are going to be dependent upon what happens in Washington, but at the same time, there's all this money, but there's just not a lot of projects, and so it's very, very challenging to to get a good handle on the political nature of infrastructure, what the future of what this country wants to do, and in my opinion, what it really does, it crystallizes 2 arguments. One, who do we want to control the infrastructure? Is it the federal government, such as the Federal Highway Trust Fund, to have a matching program? Or do we want more control really with the states and local government? And that really kind of goes back to how currently the infrastructure in this country is being subsidized is in the tax-exempt market, because that is a subsidy that the issuers get when they're trying to build their projects. And so I think at the end of the day, with the Congressman, and I applaud your efforts, it's really a tool that's going to supplement the existing market. And so whether it's a private activity bond, and I don't want to get too technical here, but there's a lot of ideas out there that can really be beneficial whether you're an equity investor or a fixed income investor in infrastructure. And really, I think if you look at power, where we've dedicated a lot of our time and resources currently, that sector has really blossomed into a P3, or where private equity or insurance money or endowments can make investments. But on transportation and other infrastructure assets, it's still evolving. And I think it's it's a long-winded answer, but I think really what it does is it shows you how hard it is to really develop a team and really develop a concrete strategy on really limited pipelines, because you're just not quite sure when these projects will really be shovel ready at the end of the day.
By the way, speaking of shovel ready, I mean we had an experience with that in the stimulus bill some years ago, when I think the idea was, of course, that was in the crush of the recession. The idea was that if we had all of these projects that were shovel ready to go, and if we just had the money, we could get things going. And it didn't quite roll out that way. I think it was very helpful if you look at some of the data on the level of spending. It did help sustain spending at some level. But it wasn't really the panacea that one thought. I mean, it reflected a little more complication. So there's regulatory issues, there's permitting issues. On the way over here to the room, Chuck, I won't mention the client that we were talking about, but you were making observations about the work that you do around the world, and some clients, some government clients, are either easier to work with, or a little more predictable, or the like. Could you comment briefly on all that we're talking about here in the U.S., how your experience, working for in the U.S. market, compares? You mentioned you're in Dubai, you're in Mexico City, you're in other parts of the world that some of us, think are more or less stable than others. But how does it get you excited that you'd want to do more work here at home, or how does our experience compare to what you're seeing globally?
Yeah, well, there's no question that if you go to markets like Dubai and Abu Dhabi and Singapore, and we're starting to see Doha and parts of Saudi Arabia, where the government is all aligned, that they want the infrastructure and they want it very quickly. And this is not low quality infrastructure at all. It's all designed to the same standards everything here meets. But it's delivered on really record time. I mean, multiple billions of dollars of infrastructure delivered in less than 24 months in some cases. That's not possible in the United States with our regulatory and permitting constraints. So it's just a fact of business. However, there are many other things that make investment in the United States very plausible and we think good investments. So when we look at a large infrastructure investment, take like a toll road or a transit system or a bridge, we really see that the expertise that consortiums like us bring, and we don't work alone. We also want to manage risk and reward. So we put together large joint ventures of other very technically competent engineering and construction companies to deliver the asset, and we will take stakes in the equity. We believe that our stake is most valuable during that phase of delivering the asset, when there's theoretically the highest risk of performance. Once we've delivered the asset, now you're in a very stable cash flow stream. Probably not a lot we're bringing, and things like insurance funds and pension funds probably have a lot more correlation to those assets than we do. But somebody's got to get that asset ready for those investment classes, and we see that as being our job. And the United States, because of its transparency and laws and so forth, it's a very attractive place to invest. So we think there's a lot of opportunity in U.S. infrastructure.
I'm going to talk a little bit about this issue of investable assets. Because I think you laid it out nicely that you got to build it, and then others, it's a little, once it's de-risked and at a different stage in the process, it may be a little more attractive to other investors, institutional investors who may not want to take the kind of greenfield, the higher risk greenfield project. But let me first ask the Congressman briefly whether any part of your legislation does or could have some feature that would accelerate the delivery. I know that you're kind of making the resources available to state and local players where projects are delivered, but is there an opportunity to kind of accelerate the delivery process as well?
Yeah, we put in place in the bill what are effectively these regional accelerators, where local governments can come together and figure out ways of streamlining the permitting process, which is obviously very burdensome, and it's leading to a situation where even if you had all the money in the world, if you don't have a robust pipeline of projects that are ready to go, where people are willing to invest the time and the resources in getting them so that they can be built, assuming the money were there, that's a big part of the issue as well, because you don't want to just solve the money side without also dealing with some of the permitting issues as well. So we do have that. We do have and we're looking for more ideas to try to do more of that. It's hard, but the best idea that we were able to come up with are these regional accelerators where people would get together and effectively agree. We've also looked at some things about giving the president actually effectively the ability to prioritize projects and give them a fast track approval, which we think would also be important. But those would generally be very consequential projects that are really in the national interest of the country, obviously. But it's a problem. It's a real problem. And you mentioned the stimulus bill. I mean, one of the problems with the stimulus bill was that it didn't do enough for infrastructure. Right? It was a pretty small allocation. I think people thought the stimulus bill was a lot of infrastructure, but it was really only about 10 to 15% of the money that was set aside in that very large and important stimulus bill was set aside for infrastructure. And I tend to think that if we would have done much more infrastructure in the stimulus bill, that even if it was a larger stimulus, in other words, rather than doing 10 to 15% of a $900 billion stimulus, if we would have done 30 or 40 or 50% of a $1.5 trillion stimulus, we'd be in a much different position as a country right now in terms of economic growth, and even our deficits and debt, in my opinion, would be lower. So we just didn't spend the money. And part of it was that shovel ready. The shovel ready thing sounds good, but it's really the worst way to think about infrastructure. The right way to think about infrastructure is long-term thoughtful planning, and so that you do the right things as opposed to doing the things that are just ready to go. So I think that was part of the, they were so focused on getting short-term stimulus, which I understand. But in my opinion, if you commit to long-term infrastructure projects, that actually creates a lot of short-term stimulus, while you're getting there. I know, and I'm not an expert on LA because I don't live here, but I know when it was pretty clear they were going to extend the subway from downtown LA to Santa Monica, even before that was built, a lot of behavior changed around the routes in terms of what people did with their property, how they changed the zoning, how they started thinking about more intensive uses. So a lot of stimulus occurs even when even when you're not doing short-term infrastructure, but you're making firm commitments to long-term, really important projects.
But well, I mean, the one thing I guess on that, Congressman, I mean, I think that's part of the investor's problem in many ways because we look at the Highway Trust Fund,
Right.
and we've just seen 6 months or
Yes.
9 months patches
Huge
all the
issue.
time.
Right.
And so, when we're looking to, and I think that's really a good way to analyze power investments and transportation investments because power doesn't need that, long term, whether it's 4 or 6 year, I guess assistance from the Fed,
Yes.
so to speak, but transportation does. And so when you're really looking from an investor's point of view, that's why I think why the public power, the power sector or renewables has really taken off versus, why we're not, supporting, HOV lanes or mass transit and so forth. And so it is kind of, we need your thoughtful leadership
Right.
to get that bill passed or, there's a lot of ideas out there, but that really will spur on some of these charts that will probably, hopefully narrow that gap of how bad the infrastructure currently is.
And the transportation business is always going to largely be a government business, right? Because the power projects and other thing, they're the ultimate user fee projects in many ways. So those work great in the private markets. But transportation, toll roads we can do,
Right.
but only in certain communities, let's face it. The overwhelming majority of the transportation infrastructure in this country will continue to be, as it should be, will continue to be funded by taxpayer dollars. And that's why things like a 6-year bill, to your point, I think are really important so local governments actually have the confidence that they can start moving forward with some of their projects. And some of those will involve, like where I live in Maryland, I see a pretty stark example of this because we have the Washington Beltway. And Virginia has been much smarter about things than we have because they've actually taken the Beltway and they've widened it with toll roads. But what they did as part of widening with toll road is they also increased the number of free lanes. So it was a total win-win for everything. The free lanes increased and you added toll roads, which obviously help the people who want to pay the tolls, but it also helps the people who want to go in the free lanes because it takes traffic off them. We haven't done as much of that in Maryland. We haven't been as forward thinking about public-private partnerships. But in those situations, private capital makes a lot of sense with transportation, but still most of it is driven by public funding at the end of the day.
Let me ask, there's a couple of themes or questions I think that come to mind in hearing both sets of comments. We were talking a lot about the even going back to the stimulus bill. One of my personal concerns about that approach was the idea of just when it was initially going to be an infrastructure bill. The idea of just taking massive amounts of government money and trying to flush it through the same kind of broken systems that we have now, was not, I mean, in an urgency period, maybe that would be appropriate, but some concern about just taking good money and pushing it through some inefficient processes. So there's talk about, reforming some of the permitting. The president's got the dashboard and so on. You were mentioning the way in which some of these things work in the power sector, for example, and now the administration is Treasury. Some of you may have seen put out a paper just the other day that was proposing that in transportation that we now look beyond the current model of either toll roads and user fees or availability payments and try to maybe incorporate some of the structures that you see in the power and telecom sectors. Right. And so you have a lot of proposals and a lot of ideas out there, and I think part of the question is how ready really is everybody to take on a new paradigm for investment? I mean, we try to generally, think of government as the slower, more bureaucratic, private sector being more nimble and quick, although there's some question about whether the pension funds and others that really want to play in this game have the capacity internally to do that kind of work. So I'd like you to comment on that. But both you and Chuck on this issue of, I'm going to ask you, Chuck, to comment on the level of capacity you see sitting across the table from your government partners. But what I'm thinking of, you just have this picture where we're talking about new ideas that potentially may increase the complication level or the level of complexity, not only in what actually gets built, but how their projects are going to be structured and financed. And is everybody really ready?
That's a great question and a lot to cover. But
I said it was like three themes, kind of into one.
I think let's just take them one by one. The Treasury paper that came out last week really talks about how to structure revenue sharing different structures with a state or local government with a private sponsor or the banks. And I think those are opportunities that every case will be different, but it's something from an investor's point of view that we're very comfortable with. Because it really does, on the riskier projects where you're taking more of that risk, your rewards will be greater. And if the inefficiency can't be eliminated, then obviously, you're having a bigger loss or potential bigger loss on your hands. So you have to be very prudent. And it really goes back to diversifying your portfolio. Is that you don't want 100% in a revenue sharing program with some state. You want a combination of the different models. But I think the bigger question, Dale, that you're really focusing on is that there's something called TIFIA, which is a major success program out of Treasury and transportation to help major transportation projects in the United States. It took roughly, I'd say, maybe 5 to 10 years to really catch fire with sponsors, construction.
There's a slide also while you're
sorry.
talking that shows, I think, the level of TIFIA
Right.
investment in the country.
And so the challenge at the end of the day is that if we want P3s to supplement really the different ways to finance infrastructure, if we keep on introducing new ideas, it's going to take the investment world as well as sponsors more time to really put together the most optimal construction or plan of finance. But there's definitely a room for it. It just boils down to we don't want to complicate it too much, because then people are really going to go back to the tools that they know, and that's really TIFIA, and that's taken. I don't have the facts in front of me, but I think that's probably at least 10 years to get those projects.
And it's not. I think it's given the bigger picture in the context of where we are. It's encouraging and
Right.
impressive. Although, given the size of the country and the needs, if you took out the busyness of that slide, the sheer number of transactions would not be clearly as many as we would like to see.
Correct.
Picking up on this theme, Chuck, looking a little longer term and thinking in your business, you probably have your finance team, you have your engineers and others. I know in higher education, for example, many of the top schools are now offering these advanced programs that blend MBA and engineering and MBA. So you've got an engineer a new generation of engineers coming out that'll know a lot more about how they finance what they're building. Do you have that thinking process siloed in your business, or are you also kind of having to do a little rethinking about the internal capacity and to match the sophistication level of the kinds of deals you're having to engage in?
Well, there's no question the skills that are taken to do a large P3 or design, build, own, operate, transfer project are a lot more complicated than to just do a traditional, what we would call design, bid, build, or even design, build. Having said that, we started at our Parsons University reinvesting and training our folks for these more beginning-to-end projects. And to that end, one of the things that comes out in these competitions, I guess there's a couple things we haven't mentioned I'd like to mention, is that one, they are more complicated, but that's where you really have the opportunity to now bring innovation. So every bid that goes off, you have multiple teams really spending millions of their own dollars to re-engineer how the asset's going to be built, to optimize it for long-term, for upfront capital costs and long-term O&M costs. And that is just a much more creative process than I think traditionally takes place in the traditional design, bid, build. Well, in doing that, you're driving out lots of time and money in delivering these assets. So the public is very much a winner because they're getting lower cost, speedier solutions. And what we're seeing now is taking these solutions not just to power and transportation, but in the state of California, we have huge water problems. There are huge opportunities in water and wastewater. And there are financing streams for those because everybody gets a water bill of one type or another. So we see that as tremendous opportunity. But it does take a different mindset by our management teams. And so our teams are all collaborative. They are multidisciplined. We have our finance team, our project management team, our design and engineering team, our construction team, our operations and maintenance team. And then we're all doing that in joint venture with other firms. So our collaboration skills in an industry that's typically thought of as being steel-toed boots and Levi's, we've gotten far more collaborative as time's gone on.
Well, before we're gonna want to turn to a section where we open up for some questions from those of you out there. So if you have a question or even a comment you'd like to throw into the mix, please start clearing your throat, if you will. Before we get there, let me ask the congressman to step back from this picture just broadly and comment on the whether or not your colleagues, in the House or just in Washington, have the capacity that we need today to really look long term. That there's a sense, I think, in some of these conversations that behind every one of these comments almost is that some project in someone's district that's been argued about for many years and so on. So we all kind of understand that locally. But as a nation, even if you do everything we're talking about here, we're still probably making reasonable headway on a very large backlog that is many years in the making. So it's going to take many, many years of effort, sustained effort, to really overcome. Do we have that capacity in Washington these days?
I think around infrastructure we have more of that capacity than we do on other things, right? So the Congress, and I'm new to it. I'm just starting my second term after spending most of my career in the private sector. The Congress was not designed to be gifted at long-term thinking. With a 2-year election cycle, right? So it's just not the core strength of the institution, I would say. Which is a polite way of framing it. But I think around infrastructure there is much more broad-based bipartisan support to doing things, and I think there's a couple of reasons for that. So my Democratic colleagues, increasing our investment in infrastructure has been a really important part of our progressive platform for a long time, for all the reasons I said in the beginning. It puts people to work. It's been shown to be one of the best areas where government spends money in terms of having an impact on the labor market and the quality or the standard of living. And it's very good for competitiveness. And I think my Republican colleagues largely agree with that. I think it's one of the areas that people see a very important role for government. There's a lot of things we debate in Washington, and there's a lot of debate about whether government should be doing certain things. A lot of people say, for example, the government shouldn't be building healthcare websites. Right, you'll get a lot of debate on that, but you don't get a lot of debate around the notion, is there a role for the federal government in investing in helping to build the nation's infrastructure? It's viewed as a strategic asset. It's something that we take pride in, and as the president likes to say, Republicans like doing ribbon cuttings as much as Democrats do. There are certain people who want to devolve all of transportation, for example, and all of infrastructure to the states, but I think that's a really small minority of the Congress. Most people think a little more broadly and view the fact that having a national high-quality infrastructure portfolio is good for every state and it's good for the country. So I think this is one of the areas where there's the most significant opportunity for bipartisan. The question is, how do you pay for it? And that's why I think our approach, which is to find some new revenues, is really important. And I think when you find new revenues in the Congress, a lot of hands go out for that money. Right, a lot of people want it for education. A lot of people want it for different social programs, entitlement programs, etc. Why we've tried to, and the international tax system, the reform in the international tax system, is I think by any measure, most people agree, is the best opportunity for additional revenues. And rather than using that money to reduce tax rates or to invest in other programs, we've basically taken the view that it should all be used for infrastructure because there's the most fundamental bipartisan support around that as a concept. So, I do think there's the opportunity for some long-term. Now, long-term will be 6 years.
6 years.
But listen, a 6-year transportation bill would be a really great thing for the Congress to do. I think it's something that we'd be really proud of and would be a great thing for the American people. And I think setting up some of these infrastructure funds or infrastructure banks, which could have lives much longer than that, I think is important. But what I do think is important about infrastructure, and the comments were made about this already, the more we can get infrastructure into a funding framework that's not subject to annual appropriations, the better. Because it is fundamentally not a business that, it's like mismatched assets and liabilities, right? Your infrastructure planning and how much time has to go into it and the commitments you have to make are really long term. And to the extent we can have it funded with ways that are not subject to this annual political cycle, the better.
Do we have some questions or comments? Let's see, we have several. Okay, why don't we start right here in the front then?
You asked a very interesting question of Mr. Harrington question about doing projects in the U.S. versus in other countries, and you gave a very full answer. I can't resist bringing up with the Congressman the Keystone Pipeline and what I think is such a shameful episode with our administration sending a message to Congress which has such a chilling effect on the notion that there can be bipartisan support for any bill because of the controversy that surrounds this Keystone Pipeline, which really, in my view, is bogus. I mean, Boone Pickens, I quote, saying that this is like the U.S. receives a Christmas present wrapped up in a bow. We don't have to defend it. It goes down the middle of our country. And how Congress has spoken on this issue and the President has ignored it. I think it sends such a bad tone.
Did you want to comment?
I mean, look, the Keystone stopped becoming an infrastructure issue and became the iconic symbol of the environmental movement, right? That's what it really became. And my opinion on Keystone is it should have been approved or rejected within 5 minutes, that it's not that consequential on either side of the aisle. I'm actually not that supportive of the Keystone Pipeline. I don't think it does that much for the United States of America. I understand what it does for Canada, right? It gets their oil, which is not really owned by us, onto the world market and raises the price of it. I get that. And it does certainly create a lot of construction jobs for a period of time. Doesn't create a lot of permanent jobs, but it does create a lot of construction jobs. And no construction jobs are permanent, so it clearly creates a lot of construction jobs. But, the truth of the matter is, I think no matter what side of this debate you're on, it became too big of an issue. And it became more of a symbol than the substance of it.
Yes, ma'am.
Hi. I have a question for the Congressman also. In your description of it sounds very appealing about the fund and the
Yes.
infrastructure. Unless I'm misunderstanding what you said, it sounded like all these funds would be going to highway development. So to speak
Sure.
to the issue about public transport, the process and the substance of how this gets into this infrastructure.
Sure. So I should have clarified. So in our bill, we're doing two things. One, we're funding the Highway Trust Fund, which is largely surface transportation, but it also deals with mass transit. Right? It's about 80-20, 80% surface, 20% mass transit. That's what it does now, and we're just adding funding to that. We're not changing how it operates. We're just providing funding. The infrastructure fund that we create, the American Infrastructure Fund, which is a large scale, some people call it an infrastructure bank, but we really envision it more as a bond guarantor. That has a much broader mandate. So that deals with what we call all the food groups of infrastructure. So you have transportation, you have energy, you have communications, you have water. We even include educational facilities as eligible infrastructure projects for states and local governments to access the money for in that bill. So that's got a much broader mandate of what's eligible infrastructure.
So was there much debate about the 80-20?
Well, there's a lot of debate about that in general, right? So there are people who live in rural areas who think we put too much money towards mass transportation and not enough towards highways, and there's people who live in urban areas who think we put too much towards transportation and not enough towards mass transit. That's a bit of an enduring debate around the Highway Trust Fund to begin with. Our view was not to get into we didn't want to get into how the Highway Trust Fund spends the money, because that's, quite frankly, subject to an already fairly elaborate process already in government. We want it, and it works, and it's funded, and people debate about the projects, but in general, I think it works pretty darn well. What we wanted to get at was the funding shortfall that exists, and to close that gap, not at the same time then change. We have a big enough fight trying to get it funded, let alone then saying, okay, we're going to change then how it operates.
And so it could conceivably, how it operates in that ratio could change the other direction.
Yeah, that's always discussed. And in fact, there's always been compromise bills talked about, which is, some of my Republican colleagues would support more funding in the Highway Trust Fund, for example, if more of it went towards transportation. And there's been bills went towards road construction. There's been bills to that effect. So there's always been debates about how to change that mix.
Let's go to this gentleman over here on the side first.
What's the thought
the Build America bonds?
Yeah, it's not something that's discussed all that much, is my sense.
We would love
Wasn't
it.
that a,
What's that?
We would love to have
Yeah.
it back. It was a great diversification tool as well.
yes, sir.
I think the financial engineering is brilliant that you've come up with, in all honesty. I think it is an enabler, but there's still another bottleneck, which is the actual planning side and actually getting the shovels into the ground, and hence Parsons Group finding it easier
Yes.
to allocate their resources into other markets. We studied we looked at a case study between China and India, and there was an investment into two airports simultaneously, and the Chinese investment actually outperformed the Indian investment just because of the simplicity of getting things done. Could you talk about how you anticipate, you're not a genie in the lamp that you can solve everything, but this is a big step that you've obviously taken, but what steps can be taken to simplify the process to enable transactions to actually happen so that Guggenheim and others can actually get the capital into these projects?
Well, and it's a really good question, and it's very hard to solve all those problems at the federal level because the states have so much control, and local governments have some, local communities have certain controls about how projects get approved. So we've kicked around ideas about conditioning the money on certain types of approvals. We ended up not doing that. I thought that was kind of an interesting idea, but there was a lot of pushback to that from both sides of the aisle. My Democratic colleagues thought that was gutting regulations. A lot of my Republican colleagues thought it was taking away rights that states had and local governments have. So you find no friends with proposals like that, even though you're like, that sounds like a pretty good idea. If you want the money, you got to get approvals quickly. Didn't seem that objectionable, but I found very few supporters of things like that. So we came up with basically this regional accelerator concept where we'd actually help, and that would be part of the program, help structure these commissions that cut across regions and help come up with ways of streamlining approval processes, and all the communities and all the jurisdictions would adopt them. I mean, I see it in my own state. In the state of Maryland, it takes twice as long to build a new intersection in Maryland as it does in Virginia. And, I've driven around Virginia a lot, and the new intersections in Virginia seem perfectly safe to me. So it's not a question of quality, it's a question of bureaucratic. And you hear about the stories of the Port of Miami, which after 14 years still hasn't received the permits to get the additional dredging done. It's a real national disgrace because we don't have to compromise quality, we just have to be much more efficient about how to do it. But part of the strength of our country is also the limiting factors as it relates to some of these things, because unlike China, which the central government has broad powers to do whatever they want, including have a bulldozer show up at someone's house and you're out of there, and the bulldozer keeps going. We obviously have a lot more protections than that, and it's tough. But we're thinking about ways to do it. But it's all part of this pipeline enhancement process.
And I know, by the way, Chuck, you mentioned this as well, that the idea that it's easier or it's much more difficult to build in the built environment, right?
Yes.
Than it is in other countries you're dealing with that probably are developing and don't have the same level of infrastructure. Let's try to get two more in since we have 5 minutes left. We're going to go to this gentleman, and then let's go up here first, and then we'll.
I work for a multi-strategy hedge fund in New York, and we basically do a lot of private credit. So we're looking for things that we can lend and make 10 to 20%, or maybe more if we can get some equity. So for us, infrastructure is something that we seek to do, but we seek to do it internationally because there's no market where you can make those kind of returns in the U.S. Whether it's because of red tape or just because it's a mature market. I was recently approached by an emerging market, a frontier market conglomerate who wants to do a hydro project, and it really opened my eyes because what's happening with them is they're being approached by the Chinese who want to build the project so they can own it and export to nearby power consumers, and they have no alternative because no private capital will avail themselves to them, but they love the U.S. and they'd much rather have the U.S. fund it than the Chinese by leaps and bounds because they get the game and they know that the Chinese just want to own their national resources. The challenge there is I think China is clearly viewing not just energy but also infrastructure as a strategic investment throughout the world and not just within their borders. Is there a way that the U.S. can really compete with China in that respect? And I love the concept about the fund, but is there a way to do for the U.S. to put some capital behind, doing more infrastructure investments globally as opposed to just within our borders?
Maybe I could address
You want to
that.
speak to
Yeah,
that?
actually, where I've seen international, where not so much the U.S. government, although there are things like USAID and Exim Bank that have helped, it was more U.S. companies going out and developing it and getting U.S. investors involved. As long as we can figure out the cash flow stream, and usually that requires a multinational, large industrial customer set that's doing the offtake. You're providing power to global oil and gas companies developing oil fields, whether it's hydro or other types of power. You're providing water for seawater injection systems, and we're like you. You'll see much higher returns, much higher risk, but generally manageable risk. But I personally haven't seen too much U.S. federal government or state government involved in projects like that.
And in fact, probably the closest we have is the public pension funds that are looking to put some money in. And even there, this was the question before about whether they really have the internal capacity to invest directly in some projects instead of investing through a fund. Did you still have a question?
I sure do, and it's a good one to end on. So it seems like every conversation.
I'll determine that.
Yes, but it really is. You'll see. I will surprise and delight. So it seems like every conversation about infrastructure, when you talk about the future is 6 to 10 years into the future, and that's really about closing a gap for what's recently not been happening in the past. So my question is, what's the role of a public-private partnership, if that's even possible, to go into the far future where I work? And to build to sort of plant the seeds for the infrastructure to come. So whether it's a hyperloop connecting, I'm on the Amtrak Acela, unfortunately, every week. So whether or not it's a hyperloop connecting, DC to New York via Elon Musk and maybe somebody in DC, or something else, like who's going to be investing in that, and what possibilities are there? So I'd love for you all to sort of talk about the far future versus the next 6 to 10 years.
Boy, well, I will make a brief comment from the standpoint of firm. Of course, we do a lot of vertical, structures and building some big civil projects as well. But one of the questions you hear quite often from clients is about their changing needs. So even the first slide we showed that big number, that the D+ grade. Those numbers at some level assume that there's a price tag for just simply replacing everything we have now. That everything we have now that's in its useful life, we're going to rebuild it, so there's the price tag on that. And the reality is that I think is reflecting your question is there is a lot of uncertainty about the kind of capacity you need, whether it's in hospitals where now we're trying to get people out of the hospital and treated at home, so you don't need as many patient beds as you needed 50 years ago. Or if we do have driverless cars and you can get many more people in you can get more capacity on existing roadways. There's some questions about, well, do you really need that new tunnel or that new overpass or those things? So there's a lot of uncertainty about the real long term. I can tell you that at least from a project standpoint, or a lot of our contracts increasingly have mechanisms to accommodate changes in use or purpose of a particular asset. But that's difficult to do on something like a road. It's easier to do on a building where you can kind of contemplate, you can negotiate how that would work at year 15 if you've got to repurpose a building. It's much more difficult to do for an airport or for a large transportation system where you really are, once you're locked in for 50, 75, 100 years once you're building something. So I just point out that you're right, that it's a great question to kind of close with, because there is a lot of, one of the reasons that a lot of these decisions are slow in making is not simply because of pesky political people at the local level who don't want to see projects go. That's certainly part of the picture. But there is this broader level of uncertainty about changing technology and how that's going to change the not only what we need, but how infrastructure needs to perform. And for how long over time. So let me ask before we close out if anyone has not only if you either have an answer to the question, if you've got a crystal ball, you really can answer it, or if you at least have an opinion as to how we ought to think about it.
Well, we have been approached on some of the bullet trains that are being developed on the infrastructure side, and I think it really boils down to trying to come up with the lowest cost of capital, as well as who ultimately is going to control that asset. And whether it's in Florida or Texas or even California, that ultimately is something that we're still struggling with because they're really, I think it's still an evolving market, an evolving asset class. So not really quite sure that's the right answer, but that's how we're approaching it internally.
One of the things I'd like to add, if you look at some of the really, take transportation example, steel structures were developed by steel companies looking for new places to sell steel. And that's where steel bridges came from. And the Hyperloop's another example of private industry really being innovative and thinking way out ahead, which probably are in a better position to do than the government. So even in things like when we work overseas, we often experiment with different types of paving materials, working on hybrid construction materials with carbon fiber and things like that. You would never get through the permit processes in this country. So it's unfortunate that really innovative U.S. companies do most of our innovation abroad. Streetlights is an example. We've used multicolored streetlights for years in different countries. In this country, they're not acceptable. You have to have 3 different lights, not just one that changes colors. But there are huge opportunities for that. And there are, as we look at it, we realize every day we're competing against firms from Japan and China and Korea and Brazil and France and Italy and Germany and UK. We have to be innovative. Innovation used to be the key to success. Now it's the key to survival. So we're constantly looking out 10, 15, 20 years in what we're investing in terms of future technologies that we can deploy here or abroad. I think that's the right place for that to be done myself.
Well, let me say as we're out of time that as you hopefully got a sense from our conversation today that there are more people, both in the public and private sector sides, thinking about working on trying to innovate in this space, not just with the infrastructure itself, but with the structures and mechanisms for financing infrastructure. And so it's sometimes difficult to see progress when it's being made, but I think at least hopefully we would have some consensus amongst the panelists here that progress is being made, incremental as it may be. Progress is being made, and we'll look forward to coming back at a future conference and talking with some of you more about the market as it's evolving. Thank you very much for your attention.